If you're ignoring the market signals that are emerging right now in Q1 of 2026, you are at risk of missing the greatest asset repricing in history.
And we're not just talking about a small move.
No, we are talking about a transition from a $3 trillion market to a $28 trillion ecosystem.
So if you're sitting on your hands because of a few red candles, you might be making the most expensive mistake of your life.
And here's the crazy part, the twist that makes this so hard to see.
Well, yeah. The retail investors, they're panic selling.
Mm.
You see a 19% drop and everyone is screaming volatility.
Right.
But if you look underneath at the hidden real-time data from Truflation, actual inflation is sitting at 1.2%.
1.2.
Which is way lower than the official story. And it signals this inevitable massive liquidity injection that the public just is not pricing in yet.
So the crowd is looking at the price, but the smart money is looking at the plumbing. So on this deep dive, we are going to decode ARK Invest's Goldilocks setup. We'll explain why the down cycle is, mathematically over, and we will reveal the specific catch-up trade that allows you to front-run this institutional merger of banking and crypto.
It's a fascinating moment because the sentiment and the actual data they've completely divorced each other.
Let's start with that macro thesis. We pulled the latest from Cathie Wood and ARK Invest, and they've come out swinging.
Oh, yeah.
They're declaring that the bear market is officially over. Now, look, we hear this from permabulls all the time, but Cathie went on record confirming the market has bottomed.
And she called it the shallowest bear market in Bitcoin history.
I want to push back on that a little because for anyone who held through 2022 and, the choppy parts of 2025, it really didn't feel shallow. It felt brutal.
It felt brutal because of the leverage, the contagion, all the bad actors blowing up. But if you strip away the emotion and just look at the number.
The percentage drawdowns?
Right, the percentage drawdowns from the all-time highs. Compared to previous cycles, mathematically it was shallow. We didn't see that 85, 90% death spiral that just lingers for years.
The recovery was faster.
Much faster. And Wood's argument is that this wasn't just a standard halving cycle.
Okay, usually we just talk about the halving. That 4-year cycle, Bitcoin issuance gets cut, supply shock, price goes up. Simple. But she's saying there's more to it this time.
So much more. She calls it 3 revolutions in one. You have to stack them to understand why the price floor is higher this time around.
Okay, what are they?
Revolution 1 is a monetary revolution. That's your basic store of value crypto as a hedge against, fiat debasement.
The classic digital gold argument. We know that one.
Correct. But then you have Revolution 2, the financial revolution. This is DeFi, decentralized finance, yield generation, and finally the internet revolution, which is all about utility, using the blockchain for actual data, for ownership, layer 2 scaling.
So in previous cycles, we really only had that first one, the digital gold idea.
Exactly. Now we have all 3 maturing at the same time. And that creates a demand floor that just didn't exist in 2018 or 2022.
So the argument is the asset class has matured enough. It just refuses to stay dead. It has real utility now, not just pure speculation.
It's too useful to go to zero. The network effects are cemented.
Okay, so that brings us to today. Friday, January 23rd, 2026. ARK is calling this the Goldilocks setup. In economics, Goldilocks is, not too hot, not too cold. But what does that mean for the economy this quarter? What are the ingredients?
ARK points to 4 specific things that are all converging right now in Q1. It's a rare alignment. First, tax cuts.
Okay.
Second, deregulation. Third, lower interest rates. And fourth, lower inflation.
Wait, that sounds like a dream scenario for a corporation, but I see a conflict. Usually if you have tax cuts and deregulation, that spurs growth, right? Spending.
It does.
And doesn't that usually overheat the economy and cause inflation?
That is the standard textbook outcome. You stimulate, demand goes up, prices go up. But the magic here, the whole Goldilocks part, is that we are getting that growth while inflation is collapsing. We're seeing huge productivity gains, probably from all the AI and robotics integration over the last couple of years. That's driving costs down, even as demand goes up.
So we get the boom without the hangover.
That's the thesis. It just removes all the friction for capital to move. Rates are low, so money is cheap, regulations are cut, barriers are gone, It creates a vacuum that just sucks capital into risk assets.
But hold on, you said inflation is collapsing. I have to stop you there. Because when I go get a coffee or go to the grocery store, it does not feel like inflation is collapsing.
I know.
It feels like my wallet is bleeding.
Yeah.
The average person feels things are still historically expensive, so where's the disconnect?
This is the most critical part of this whole deep dive. It's the data discrepancy. You have to understand, the Fed and the government, they rely on the CPI, the Consumer Price Index.
Which is flawed.
It's notoriously flawed. It's a lagging indicator.
Right.
It's worse than lagging. It's ancient history.
Mm.
It's like driving your car at 100 miles an hour with your windshield painted black, and you're only navigating by looking in the rearview mirror.
So they're making decisions for today based on what the economy looked like 6 months ago? That feels, I mean, that's dangerous.
It is. But we have better tools now. We have Truflation. It's a blockchain oracle that tracks millions of data points in real time.
It scrapes prices from where? Amazon, Zillow?
Amazon, Zillow, Walmart, gas pumps, instantly. And Truflation is telling a very, very different story.
Okay, so what's the number?
1.2%.
1.2. That is exceptionally low. The Fed's target is 2%. If we're at 1.2, we're almost bordering on deflation.
We are flirting with it. And for a central bank, that is a huge problem. Deflation crushes debt holders, and who's the biggest debt holder in the world?
The U.S. government.
So here's why that matters for you. If the official narrative, the CPI, finally catches up to the real data, which it has to, eventually, the Fed has a massive green light.
They aren't just allowed to cut rates. They effectively have to. They have to stop the economy from freezing up.
They will be forced to cut, and cut aggressively. They need to reinflate the system to get back to 2%. They can't let prices actually start falling.
So let's connect this back to the market. Everyone is terrified of this 19% dip we just saw in crypto, but you're saying the central bank is about to flood the system with liquidity.
The scared money is selling right before the central bank turns the money printer back on. That 1.2% number is the fuel. It justifies the lower interest rates ARK is predicting.
And when rates drop, liquidity seeks yield.
It's just physics 101 for finance. It moves further out on the risk curve.
Okay, further out on the risk curve. Let's unpack that jargon. It just means investors stop buying safe, boring government bonds because the payout is terrible.
And they start looking for riskier things that might pay more, like stocks, tech, or crypto.
Right.
Think of it like a champagne tower. You pour the liquidity at the very top. That top glass is government bonds. Once it's full and the yield drops, the champagne overflows into the next tier.
Blue chip stocks, real estate.
Then growth stocks. And finally, it all flows into the most speculative, high-growth asset class.
Which is crypto.
Which is us. And that leads us to the catch-up trade.
Okay, the catch-up trade. This is the actionable part. What are we looking for?
We need to look at global M2 money supply.
M2. That's basically the measure of all the cash and easily convertible money sloshing around the economy.
Exactly. It's the ocean of liquidity. And if you look at the charts right now for the U.S., China, Japan, the Eurozone, M2 is at all-time highs.
So there's more fiat currency in the system than ever before.
Ever in human history.
Yeah.
So the money is there. The question is, where is it right now?
Well, look at the scoreboard. The stock market is at all-time highs.
Gold is at all-time highs. Prime real estate is near its highs.
And then there's crypto.
And then there's crypto. It is the only major asset class lagging behind these global highs. It hasn't repriced yet to reflect the new M2 reality.
Why not? If the money is there, why hasn't it hit us yet? Is it just the fear from this recent drop?
It's a mix of that fear and the waterfall effect. Crypto's the last glass in that champagne tower. It fills up last, but it fills up the fastest once the flow really starts.
Okay.
Look, institutional capital is simple. It hates overpaying. If stocks are expensive, and they are, and gold is expensive, but you have this new regulated asset class accessible via ETFs, and it's trading below its highs.
That's a mispricing. It's a discount.
It is a massive discount. Capital flows downhill. It flows to the undervalued asset that hasn't run yet. That asset is us.
It feels like a coiled spring. All that money supply expanding, but the price is temporarily suppressed. That tension has to resolve.
It always resolves to the upside in a liquidity expansion. Always. The math eventually wins.
But it's not just about money flowing in. The whole structure of the industry is changing. We have to talk about the banks.
Yes.
For a decade, the narrative was crypto versus the banks. It was a war. Ideologically, they were enemies.
That war is over. And in a way, the banks won by just absorbing the enemy. We have to look at the market structure bill that's sitting in the Senate AG committee.
This is the U.S.-specific bill that finally clarifies the rules, right? Because we've been in a gray area for years.
It's the official rule book,
Yeah.
and David Sachs made a really profound prediction about this. He said once this bill passes, and it's moving fast, banks won't just partner with crypto companies.
What?
They will become the crypto industry.
That's a bold statement. What does that even look like, banks becoming the crypto industry?
Well, think about what a bank really is. Forget the marble floors and ATMs. A bank is just a ledger, a database that tracks who owns what.
Yeah.
Crypto technology, the blockchain, is just a fundamentally better, cheaper, faster ledger.
So they're not looking at Bitcoin as magic internet money anymore. They're looking at the tech and saying, hey, this is cheaper than our 1970s COBOL software.
Precisely. It's a technology upgrade. Sachs is arguing the market structure bill gives the big U.S. banks, your J.P. Morgans, your Bank of Americas, the permission slip to fully integrate these blockchain rails.
So we won't see a crypto industry over here and a banking industry over there.
No, that line just vanishes. It all merges into one digital asset industry. You won't have a crypto wallet and a separate bank account. You'll just have a bank account that runs on crypto rails.
You'll send dollars, but they'll move as stable coins on the back end.
Or hold tokenized stocks right in your checking account. Yes.
Yeah, I mean, that is the ultimate validation. But it also implies the ultimate wall of money. If the banks are the industry, then their balance sheets become the industry's balance sheets.
And that brings us right back to the valuation.
Yeah.
Because if you integrate the entire global banking system into this asset class, the current market cap is it's laughable.
Which brings us to the headline number for today, the $28 trillion roadmap.
This is straight from ARK Invest's Big Ideas 2026 report. They project digital assets will grow from roughly $3 trillion today to $28 trillion by 2030.
Let's just pause on that. $3 trillion to $28 trillion. That's basically a 10x, a 1,000% expansion. That sounds incredible, but where does that value come from? Is that just Bitcoin to $1 million?
It's not just the price of Bitcoin. It's the scope of what the industry covers. Remember those 3 revolutions? We're not just pricing in a currency anymore.
We're pricing in the tokenization of real-world assets.
Exactly. Real estate, art, bonds.
Everything.
Everything. If you put global real estate on-chain, that adds trillions. If you put equities on-chain for 247 trading, that's trillions more.
Yeah.
ARK isn't saying Bitcoin alone is 28 trillion. They're saying the entire digital asset ecosystem absorbs that much value from the traditional world.
In 4 years.
In 4 years.
So when we look at the market today and we see that 19% drop and people are sweating.
It's a rounding error. It is noise. If you believe the thesis that we're seeing this merger of banking and crypto backed by a Goldilocks macro environment, then worrying about a 19% dip is like worrying about a penny on the sidewalk while a steamroller made of gold is heading your way.
The smart money knows this. They're ignoring the dip. They're probably buying it.
They're positioning themselves.
Yeah.
They know that once that M2 money really starts to flow and once that Senate bill passes, the window to get into these valuations closes for good. You can't put the genie back in the bottle.
It's really the difference between trading and investing. Trading is worrying about the next 15-minute candle. Investing is looking at the 2030 horizon and seeing that $28 trillion target.
Exactly. And the data, the real data, not the headlines, it supports the 2030 vision. Truflation at 1.2% supports the liquidity. The market structure bill supports the institutions. The pieces are all on the board.
It's all there for anyone willing to just look past the fear.
But that's the hard part, right? It goes against our nature to buy when everyone is screaming sell. That's why the returns are so high. You get paid for taking that psychological risk.
Okay, this is your wake-up call. If you are in the U.S., you need to be watching Crypto Global News for updates on that Senate vote. We need you to like, share, and smash that subscribe button right now.
Seriously.
Hit the bell icon to get regular updates. Do not rely on mainstream media for this. They will tell you about it after the move has already happened. You have to be ahead of it.
The roadmap to 28 trillion is clear, but the ride won't be a straight line. There is one regulatory trigger coming next month that could shake out the weak hands one last time before the banks take over.
To see the exact date of that Senate vote, click the card on your screen right now. Do not miss it.